Welcome, everybody, to today's webcast, How to Guard Against Buyer's Remorse in Today's Deal Market. I am Bob Ambrogi. I'm going to be serving as the moderator for today's program. I am a columnist for Above the Law, which is one of the sponsors of today's program, along with Latera, the legal technology company. And I'm going to introduce the panelists in just a moment, but what we're going to be talking about today is the global M&A market, which faced unprecedented levels of uncertainty in 2020, only to recover at record-breaking heights this year. But below the surface, the due diligence process has changed substantially. Today, what we're going to talk about is we're going to take a closer look at this market, what it means for legal professionals. And we'll be guided in our discussion by a new report just out from Latera, the Latera Annual M&A Report 2021, which was produced using data provided by PitchBook. Our panelists will include the analyst who authored that report and two industry experts who are going to share their insights on the report and on the market more broadly. So before I introduce the panelists, let me just say a word about Q&A. We are going to save time at the end of the program for Q&A, and so we welcome your questions. But I would draw your attention to the box at the lower left side of your screen where you can enter a question. If at any time during the course of the next hour you have a question, you don't have to wait till the end. Go ahead and drop it in there. I'll keep an eye on that, and if it's something that's pertinent to what we're talking about at any moment during the webinar, I can pull that out and bring it to the attention of the panelists. So if you have a question, go ahead and drop it in there. Other than that, we're going to get going with slides in just a moment. But first, I want to introduce the panelists, or rather invite the panelists to introduce themselves. So let me just go around. And Chauncey Lane, let me just start with you.
Thanks, Bob. Hi, everyone. Thanks for joining us today. My name is Chauncey Lane. I am a corporate M&A private equity partner in the Dallas office of Reed Smith, and glad to be here with you today.
Thanks, Chauncey. Next up, Jennifer Tsai.
Thanks, Bob. Hi, I'm Jennifer Tsai. I'm the legal knowledge analyst at Kira Systems, which is now part of the Latera family. I started my career at Weil Gotshal in New York in the private equity and M&A group, and joined Kira Systems in 2015, where I now produce our M&A deal terms and contract studies.
Thanks, Jennifer. And finally, Alex Licken.
Thanks, Bob. Hi, I am Alex Licken. I am a senior analyst at PitchBook. I have been here roughly since 2012 with a break in between. And I cover the venture capital, private equity, and M&A markets, primarily through PitchBook reports.
All right, thanks, Alex. So as I said, what we're going to be talking about today is this report out from Latera, the annual M&A report 2021. I believe, did we get somebody to drop the link for that in the chat? If not, somebody will drop the link for where you can get that report in the chat. But we're going to do, before we get into a full discussion, we're going to have Alex give a little bit of an introduction to the report, talk about some of the findings, and we'll go back and forth a little bit with Alex presenting some of the findings. He was the author of the report, so let's kick it off with Alex, and then we'll get back to a conversation about some of this. So, Alex, you want to start us off?
Absolutely. Let me see. Heading to the slides. Let's make sure that we are rolling through these. Do we have the slide with the chart on top now?
Yes.
Perfect. So by quarter, this is M&A activity. This chart should look pretty familiar, or at least not surprising. Between first quarter of 2018 and fourth quarter of 2019, you'll notice that it's remarkably similar. Things were humming along. Of course, by the second quarter of 2020, things collapsed a bit. It should pause right there to mention that these numbers reflect completed deals. So we're not looking at announced deals mixed in with completed deals. And when you look at the second quarter, primarily a lot of those deals were transactions that were struck really before the pandemic became a big topic of public discussion. There were a number of scenarios where buyers tried to get out of it, but the courts were not really sympathetic to act of God types of arguments. So second quarter went down. Third quarter, things started to pick up a little bit during the summer. And then, of course, by the fourth quarter is when things really started to rev up. Between the fourth quarter of 2020 and the second quarter of 2021, we tallied 8,561 deals, which by itself would be a record on an annual basis, just to give a sense of how big the recovery ended up being. And broadly speaking, you know, we can categorize the recovery in two big ways. At the beginning of the recovery, primarily in the third quarter, there were a number of deals that had already been on the radars of acquirers, but for whatever reason, they were passed on before the pandemic. Perhaps they had a little bit of hair on them. Perhaps there were concerns about valuations. Once the pandemic struck and things really started to change, then all of a sudden those concerns didn't look quite as bad. So there were a number of deals where acquirers essentially went back to their due diligence records and dusted them off. And many of those deals were struck with the sense that, you know, social distancing was in place, but it wasn't as big of a deal if they were already familiar with the company. There were some, I heard an anecdote about one acquirer that actually went out and bought a drone and flew it over a facility, and I think inside the facility, which I find very amusing and wish I was a fly on the wall looking at some of that footage. But, you know, acquirers went to big lengths under quarantine to try and get some of these deals off the ground, but there was a lot of hesitation among buyers, and a lot of buyers simply sidelined themselves and refused to do any deals. On the back half of the year, when we start to look at the fourth quarter of last year and the first half of 2021, we're looking at a lot of opportunism. Strategics were in a place where they really had to figure out where their markets were heading and what to do about it. Many of them took to the M&A market to buy those new capabilities instead of building them organically. In a lot of cases, they were looking to buy market share. In a lot of cases, they were looking to buy new capabilities like new technological aspects for their own companies. And there were several high-profile deals that were emblematic of how COVID was impacting their future. We highlighted the Salesforce acquisition of Slack, which came out to $27.7 billion, and I actually have the quote here. Slack CEO Stuart Butterfield saw a, quote, once-in-a-generation opportunity to rethink and reshape how and where we work. So he was being explicit when he was looking to make that deal, but it's also a very game-changing type of deal, not to mention very pricey deal. And so in those circumstances, deal makers were in a position where they had to make decisions quickly but carefully and accurately, especially at the higher end of the market. And one of the things that we pointed to in the report was that deal timelines are getting even shorter. And in the context of due diligence, I wanted us to start there and hand it back to Bob.
Great. Thanks so much, Alex, for that, for setting the stage there. Let me turn to let me bring the other panelists in and get their reactions to that. Chauncey, I just wonder if I could start with you based on your experience representing clients in this area. Did you see that kind of opportunism, and how did you respond to it? How did they respond to it?
Yeah, absolutely. You know, I absolutely saw it. And, you know, much to the point that Alex raised with Slack, many executives started to re-examine their business during COVID, right, through the latter parts of last year. And one of the results of that was focusing on those core assets, simply divesting non-core assets. Well, as those non-core assets were being divested, created an optimal chance for private equity firms to snap up those divested assets in the form of add-on acquisitions to existing portfolio companies, right? And so that created, I think, this vacuum of assets kind of being offloaded, with PE firms quickly snapping up those assets, and quite frankly, some strategics as well, picking up some of those assets that were kind of being offloaded by other strategics. So it definitely created a market where things were moving very quickly as people sought to reposition themselves for not only what was happening in the market at that time, but quite frankly, what people anticipated the market to look like after COVID, right? After restrictions started to be lifted, companies were forward thinking about where do we want to be whenever we get on the other side of COVID, right? And one way to do that is to focus on those core assets, pull in other accretive assets that actually increase your competitive advantage. So when you get past COVID, you're in a much better position to form in the market, right? So I think that was very apparent as to what was going on in the latter part of last year, and quite frankly, into the first part of this year. I think PE firms also saw some pressure from LPs, right? From LPs wanting PE firms to be more thoughtful about how they were deploying capital during the dog days of the pandemic, right? And so that pressure caused PE firms to be much more thoughtful about how they were deploying capital. That led to many PE firms focusing more on add-on acquisitions as opposed to platform acquisitions, right? And so PE firms took on, I think, a very interesting role during the dog days of the pandemic, wherein many were focusing on providing capital to their portfolio companies, right? And so it was a very different strategy being employed throughout the dog days of the pandemic. And I think that change in strategy really amped the market and really caused buyers, including strategic, to jump into the market, pick up these assets that they viewed as being accretive to what it was they were doing, likely in many instances to please shareholders, and in the case of PE firms, to appease their LPs who were really applying a lot of pressure at that time.
I'm curious what it meant for you directly or you personally. I mean, how did it change how you handled these deals?
Yeah, absolutely, right. I mean, I think, when deals are moving at a very, very quick pace, the approach to how we manage the deal process absolutely has to change, right? First and foremost, we have to be much more efficient in how we're running deals, right? Because we really are trying to manage risk, meet client expectations, and get the deal done, quite frankly, right at the end of the day. And so in order to focus on each of those three areas, we really have to focus on how we're running the deal, right? First and foremost, due diligence, right? That's a tricky area, right? When you have a client that comes to you and the client says, look, I want to get a deal done in 30 days, right? And you're talking about a substantial deal, and you're talking about a target company with a lot of due diligence. You have to think through how you're going to approach that, right? You have to be efficient in how you approach that. Sometimes you'll have a client who will say, look, we're willing to take some risk here, right? In the interest of moving this deal along quickly, we're happy to focus on these certain areas, and we're not even going to bother with these other areas, right? Then you're looking at a client management situation because, right, as I'm looking at a deal and as I'm evaluating the opportunity for the client, there may be certain times when I have to look at a client and say, look, I know you're not really concerned about that, but you actually really do need to focus on that because that presents a unique risk to your business for the future. And so if I'm going to convince that client to actually stop and look at that, I've got to make sure that I'm being efficient in how I'm approaching that, right? And so obviously, one of our panelists here, Jennifer, right? I mean, with the technology, that absolutely is how you do that, right? Is you have to bring technology into your process, both from a due diligence perspective, and then as we think about how you manage the overall process, right? How do we track this deal? How do we track the various avenues of this transaction, right? From negotiating the purchase agreement, managing the ancillaries, managing the due diligence, managing various approvals, be it third-party approvals, governmental approvals. You've got to have a process in place where you're able to quickly oversee that, quickly manage that in a way that is efficient.
Well, you queued it up to Jennifer there with your comment, but Jennifer, your expertise is in the technology around handling due diligence. So what have you seen, and how have you seen people responding to this greater urgency around deals over the last 20 months or so, whatever it's been?
Right. I think it's just like Chauncey was saying, this need for timelines to kind of speed up has required even more engagement with clients on their risk tolerance. And then, discussions, it's prompting discussions on the scope of diligence that needs to be undertaken so that everyone understands the impact of those risks. And with the shorter timelines, it really it leaves a lot more room for those kind of low frequency, high impact risks that can occur. And then, like Chauncey was saying, on the flip side, you have to strike that balance between finding those risks and also process efficiency, with the consequences being serious. And that's where AI can come in. So we can review more documents, more contracts, and then significantly increase the scope of that diligence at a lower incremental cost than was previously possible. I think another point to that too is that it's becoming more difficult for buyers to back out of deals by citing material adverse effect. So, as we saw in Acorn, and then more recently with COVID-19 in the AB stable case, we're seeing COVID-19 excluded from MAE definitions unless there's disproportionate effect. So it's really important just to have confidence in that whole due diligence and deal management process to make sure that you've kind of uncovered any issues that might exist.
Yeah. Alex, I wonder if just before we move on to the next segment, just having, based on what you've just heard from Chauncey and Jennifer, if you have any further comments on what they said, or does the data provide any further elucidation on what they were just commenting on?
No, I think Chauncey hit it on the head from a data perspective. I think the only question that I have going forward, and it's sort of an open-ended question, is how long these trends continue. There is a need for speed, and strategics have been positioning themselves to get into as good of a position as they can right now before their competitors do. But the longer that this whole scenario plays out, the longer we may see these transformative trends go on. So I don't know if it's going to be it's not going to be a real quick moment in time where all these transformative deals are taking place. I think that this has some legs to it, and it could be going on for the next 2 or 3 years.
Mm-hmm. Chauncey, any predictions on that? How long is this going to play out?
Yeah, I agree with Alex. I think we're going to see this trend continue for a while, and I think for a couple of reasons. One, I think there's still some after effects of COVID, and strategics looking to position themselves in the post-COVID marketplace, right? I think another factor is we've seen a lot of changes in the political environment. Those changes, some of which have not actually been implemented, oftentimes drive deal activity as well, as strategics and, quite frankly, private equity firms are trying to get ahead of some of these implementations, right? The most notable being tax reform, right? I think many people expect that to be on the horizon. That's going to cause deal pace to continue to be pretty swift, as companies are looking to get deals done before tax reform actually takes hold. Another is economic, right? With interest rates being low, that's going to continue driving deal activity until interest rates start to stabilize a little bit more. So I think absolutely. I think we see. I think it's quite likely this trend will continue for at least another 2 or 3 years.
And can I add on to that real quick, and almost a follow-on question to Chauncey? A lot of these transformative deals that we've been seeing, and again highlighting the Salesforce and Slack deal. Obviously, that's at the top of the market where trends tend to be set. How do you see this playing out below, perhaps at the middle market or the lower middle market? Do you see the same trends happening over time the further down you go?
Yeah, good question. I mean, I think you're absolutely right. I think there's always hyperactivity at the top of the market with whatever may be going on, right? Many of the trends absolutely bear out very clearly at the top of the market. I think the middle market, I think the trend will continue in the middle market as well. I think it will probably not last as long as it may last at the top of the market, but I absolutely expect the trend to continue in the middle market as well, right? And I think it's some of the same drivers, right? It's interest rates, it's pending tax reform, and quite frankly, I mean, I think it is as, say, other companies are offloading assets that they've determined after their strategic review that just don't quite move the needle for them. I think they create unique opportunities for the middle market as well, not just the upper tier of the market. So I think it will continue in the middle market as well.
All right, thank you. Alex, you want to take us into the next segment of your findings regarding private equity?
Yeah, and Chauncey hit on this with respect to private equity. Going back to March, April, May of 2020, private equity really hit the brakes, which was a little interesting because outwardly they were expressing a lot of optimism that this itself was a once-in-a-lifetime opportunity for private equity to buy a lot of assets at substantial discounts. The data didn't suggest that that's what happened, at least not from a platform perspective. For even through the summer of 2020, you saw a whole lot of hesitation around making new platform investments. And at the same time, whatever appetite there would be for those types of platform investments was almost counterbalanced by the need to take care of their existing portfolio companies. A lot of PE firms counseled their portfolio company CEOs to tap into existing lines of credit, which they did. In a lot of cases, the private equity sponsors needed to infuse a little bit of capital into them, and that was going on behind the scenes. But there was a dual situation where exactly were you going to spend your time? You needed to take care of your own portfolio companies, and the opportunity to go and make platform investments was there, but it turned out that appetite wasn't quite what a lot of people expected it to be. So in lieu of all that, there was something of a compromise, I suppose, that add-on acquisitions became a trend throughout the year. And even though the data didn't show that there was a mind-blowing number of them, they were in line with 2019 and 2018 numbers. And as opposed to other transaction types that private equity firms were doing, add-ons were pretty consistent across the board. So sponsors were going out and helping their own portfolio companies buy up market share, expand geographically, doing everything that they could to help their own portfolio companies in that way. And they really leaned on the buy and build strategy throughout the year. And the other position of it is that if you were private equity backed through COVID, you had a bit of a safety net in the form of a well-heeled financial sponsor who would be able to come up with solutions for you if you really needed it. So PE-backed companies were in a different position than a lot of strategics were throughout the year.
Great. So, Chauncey, let me turn again to you and just ask you what your thoughts are, what your observations were with regard to private equity companies and the impact COVID had on them.
Yeah, so I think what I saw in the market was exactly what Alex just laid out, and I touched on it a little bit in my earlier comments, right? I think the focus for private equity for much of last year was really twofold, right? It was stabilization of existing portfolio companies and focusing on those add-on investments, right? And which in some instances was a mechanism to stabilize an existing portfolio company. Not necessarily just to gain a strategic advantage in the marketplace, right? A lot of portfolio companies saw liquidity issues. They saw supply chain disruptions, right? They saw cash conversion delays, right? You've got a lot of inventory sitting on the shelf and you can't convert that inventory to cash, right? I think a lot of portfolio companies realized that they had weaknesses in business continuity plans, right? And in their existing strategy more broadly. And so I think as a result of those realizations, many of which were also impacting strategics at the time, I think private equity sponsors really had to step up and really had to take a very hands-on approach to stabilizing those portfolio companies, quite frankly. And to Alex's point, many of them ended up serving as, providing liquidity to their portfolio companies during that time, because quite frankly, the debt market was really difficult, right? It was not a very good debt market last year. And so we saw a lot of private equity firms providing debt financing to many of their portfolio companies, which was kind of an interesting role to see private equity firms playing. But many of them took on that role in the heart of the pandemic. And then when you think about add-on investments, right, much like strategics, private equity firms were also looking at their portfolio company, trying to assess what the competitive advantage of the market is at that time, as well as what the competitive advantage is going to be once COVID subsides, right? And so add-on investments were a great way not only to stabilize a portfolio company, for example, if you're bringing in some core function that was previously outsourced as a way to cut costs, but then also to gain a strategic advantage, right? And we, you know, I saw this, you know, to one degree or another, depending on the industry, right? Obviously, the service industry, restaurants, hotels, entertainment were hit really, really hard last year, right? And so I think in those industries, you saw a focus of absolute stabilization, right? I think that was kind of first and foremost was stabilize and how do we position the portfolio company to make it through this period, right? In other industries, healthcare, med tech, you know, those industries, technology, quite frankly, those industries were not necessarily hurting as bad, right? So you didn't see as much of a focus on stabilization, I think, but rather a focus on add-on investments, right? Taking this as an opportunity, finding opportunities in the current marketplace, leveraging those opportunities, and then positioning the portfolio company to further leverage those opportunities after COVID.
Yeah. I think it's interesting that you mentioned that, because I know that the report talks about some of those industries. Industry I follow very closely is legal technology, which is another industry I think that actually did pretty darn well during the last couple of years, and you did see a lot of those kind of add-on investments that you're talking about in that area. And actually, Kira is frankly it's sort of an example of that, because it was acquired by Latera during this time, and really fits that model well. Jennifer, did you have anything that you want to say on that issue of the PE companies?
Only that, you know, that the need for speed that we were talking about earlier, you know, that would have applied to these private equity deals too, right? So even though sometimes private equity, they do more strategic and targeted diligence, you know, it's still important, especially if they're doing add-on transactions, to be aware of those diligence issues, just to see if any provisions apply to affiliates, and just be aware of that.
Yeah. Could you just elaborate a little bit more on how technology serves that need for speed interest? I mean, how does it help speed up the process?
Yeah, sure. So the AI systems like that use machine learning, they can help surface key provisions faster than you'd be able to do by just a pure manual review. And so, and even with that, you know, it provides the ability to use a tech-assisted review. So not just review what's traditionally considered to be material, but to have the machine take the first cut at reviewing, you know, if you wanted, like all of the documents, so that we as attorneys can develop a better handle on the risks that come with the shorter timeframes on deal execution. So even with the technology, though, right, it doesn't mean that lawyers will be replaced, because you still need human attorney expertise to kind of develop the bigger picture and to provide further analysis and color on what the machine actually finds, so you can develop a better picture of what the legal risks look like for a contemplated transaction.
Okay. All right, Alex, you want to again take us into the next segment of your slides here?
Sure. And here we're transitioning back into broader M&A and specifically looking at multiples. At the outset of the pandemic, there was a lot of expectations that EBIT multiples were going to have to be impacted, and they were. They did vary by sector and to a lesser extent by geography. And what we really saw in 2020 was, first of all, the headline multiple did not change from 2019, which could be surprising in a sense. But when you compare the 10.5x in 2019 to the 10.5x in 2020, it's a bit of an apples and oranges comparison, because at the end of the day, you were looking at a different mix of companies on the market. 2019 was a much healthier, normal year with a broad range of companies that were up for sale. In 2020, you were really looking at several sectors and several subsectors of those sectors that essentially sidelined themselves and took themselves off the market. We've talked about this, but talking travel, restaurants, hotels, entertainment, one of the hardest hit sectors was the B2B subsector that does conference planning, in-person conference planning. That industry basically came to an absolute standstill. So going into 2021, the median multiple through the third quarter is 11.4x. And, really what a lot of what we're seeing today is a continuation of a number of companies that had a COVID premium. So the companies that were actually on the market, many of them were impacted, but not very much so by COVID. And a lot of them were positively affected by COVID. So you're thinking software, you're thinking a lot of, remote work, remote learning, e-commerce was a big sector. So I think that about wraps up that point. But I mean, there's a lot to unpack when you're talking about multiples, right? So I'm curious what Jen and Chauncey have to say from a more on the boots on the ground perspective as to what they saw at the peak of the pandemic, what kind of companies were coming into market, and what kind of companies were coming in later, and how much later in the year where things started to normalize a little bit.
Okay. Chauncey, what's your answer to that? What kinds of companies were you seeing coming in at different points over the last 20 months or so?
Yeah, lots of tech. To Alex's point, right? I mean, we saw a turn to a distributed work environment last year, and for many companies still right now, right? And so, in order to support that distributed work environment, tech became key. Right, as you start to rely more on things like cloud computing, software, technology was a main driver behind a successful transition to a distributed work environment. But then you have the flip side of that, and then you got data privacy, you've got cybersecurity, right? And so that kind of led you to the other side of the tech world in order to support, right? So you had the technology that was necessary to allow people to work remotely, but then you needed to bring in place the technology that would make that a safe environment for the company and the data that the company manages. So I think those are the types of companies that immediately experienced a COVID premium, right? I think interestingly enough, now that we are, say, in Q4 of 2021, there are some companies who see a COVID premium still today, but it's because, hey, look, we're doing way better than we were doing last year, right? And so we think that because we are so outperforming what we did last year, we should get a premium for that, right? And obviously, I think buyers struggle with that a little bit because you're pointing to a low period and then claiming because you've outperformed from that low period, you're entitled to a premium, right? So, and to Alex's other point, right, I was also surprised, right, to see that multiples stayed fairly steady through much of 2020, right? And I think the reason for that is most of the companies that were being acquired, most of the companies in the market at that time had strong balance sheets, right? Those companies had strong assets, right? Because to another point that Alex made, many companies kind of sat on the sidelines, right? Particularly if they knew that they were not yet positioned to get the best value for the business. Many of those companies just took themselves out of contention. And so the deals that were being done were deals with great companies, strong assets, right? Very short cash conversion periods, right? Companies that weren't experiencing significant supply chain disruptions. And so those were companies that were still in a position to command a higher multiple, and they were getting that higher multiple. And so I think that's what really kept multiples higher than what I think many people expected multiples would have been in the heart of the pandemic. Then, of course, I think you had the opposite side of that, right? And that is the ability to get a deal done in that kind of environment, right? Because a buyer may have one expectation of value, as is often the case, than what the seller has in terms of its expectation of value, right? And so those disagreements, I think, really kind of took shape especially at the upper tier of the market, right? Because you've got sellers with overly optimistic revenue projections, right? Because, for example, they are, a cloud computing company, and right now their services are really in demand. Right. And so they come to the table with an overly optimistic revenue projection. And a buyer, right, has to assess, well, what is the likelihood that this demand will continue into the future? Right. Or is this just right now? And so a buyer has to juggle with that. Right. I think another aspect of that is we saw a lot of, a really big impact on MAE provisions, right? Material adverse effect provisions as well, right? And so there was a lot of negotiation over that as well, right? And so oftentimes that plays into what that value is, right? Because if as a buyer, I'm going to be assuming a significant amount of risk, then I'm probably going to have a different expectation of what the value of this business is, because that's a lot of risk that I've got to be compensated for, right? So, and I think that takes us back to a point Jennifer mentioned earlier, and that is, and I think the report kind of touches on this, right? Where speed is key, accuracy and comprehensiveness are at risk, right? Because that buyer has to assess that risk, right? Because that is a direct flow into what the value of that business is, right? And so if a buyer is moving too quickly, not closely assessing that risk, a buyer might find itself in a situation where it is accepting a higher value than what is actually really appropriate in that circumstance, right? And so assessing what was the real impact of COVID on this business now and in the future, right? Is this real demand or is this temporary demand? So I think the data absolutely reflects what I experienced in the marketplace as we were going through 2020, as well as going into 2021. I do think that as we go into 2021 and as we're going now into Q4, I think you're seeing more businesses coming back in play, right? I really do think that we saw a lot of, for example, telehealth, cloud computing, those other types of businesses who are really getting that COVID premium in 2020. I think in 2021, you're seeing a little more stabilization in terms of the types of companies that are able to jump into the market and get a meaningful valuation, comparatively to what, say, they were getting in 2019, maybe even 2018.
And does that include some of those industries that Alex talked about as having been, having lost valuation earlier on in the code during the pandemic?
I think so. I think those valuations are absolutely rebounding. I think that there is a desire to kind of be on the front end of those markets when they fully reopen, right? Because I think there's a lot of opportunity because there's pent-up demand, right? As we talk about the pent-up demand in the M&A space with private equity firms having a lot of dry powder, or strategics looking to make significant strategic plays as they emerge from COVID, I think you see consumers wanting to get back and travel, right? And I think that is going to drive a lot of demand as we see the COVID restrictions start to subside. And so as a result of that, I think sellers in those industries feel that they're in a position now to demand higher valuations for their businesses because of that pent-up demand.
Yeah. To those of you who are watching the webinar, just a reminder that there is a Q&A box in the lower left-hand side of your screen, and we welcome you to submit questions, or even just if you want to comment and contribute to the conversation about what we're talking about here today. Welcome you to do that. We will be taking questions. Jennifer, do you have what are your thoughts on what Alex and Chauncey were just talking about? Do you have any further thoughts on that?
Yeah, I mean, I think what Chauncey was saying with the valuations and as the report says too, with the valuation and multiples being so high, it's it's an indication that doing more complete diligence can help buyers have more confidence in that valuation being an accurate reflection of the company's actual value. Right, so it's just increasingly important to be uncovering those risks and find what you can with the technology that's available. And the accuracy is improving all the time. The machines don't get tired, so it's becoming a lot easier to get that done in the timeframes that clients are demanding. So
yeah, how much of this was done, sort of boots on the ground before COVID, and to what extent did COVID have changed kind of the whole workflow around handling these deals and require them to be done virtually to a greater extent than previously?
Yeah, from my perspective, I mean, I'll say much of the business due diligence was done on the ground, right, before COVID. I think it was quite common for both in the private equity space and the venture capital space for due diligence to be done face-to-face on the ground, getting to know the business operators, really kicking the tires on the business. When we moved into the COVID world, I think absolutely you saw a change in how due diligence was being conducted. Due diligence was being done entirely remotely, right? I mean, I've even heard stories of buyers flying drones over, right, a Target's warehouse, and just to take a look at kind of the condition of a warehouse, or flying a drone to look at inventory on shelves or something like that. So I think you saw buyers have to get very creative with how they were conducting due diligence in the heart of the pandemic. And quite frankly, I think that we will see those changes really continue to into the future, right? I think that we really have seen kind of a transformation of how due diligence can be conducted, right? And I think you only saw that exacerbated when you think of, say, a cross-border transaction, right? Think of a buyer acquiring a target that has, operations in 3 or 4 different countries. Different travel restrictions in one country, different requirements for an individual to go to that country, and so on. And so as a result, I think you saw a transformation how diligence was done. And I really do think that much of those changes will continue into the future. If for no other reason than efficiency, right? I think buyers probably realized that they can be quite efficient and still conduct effective due diligence without necessarily being their boots on the ground.
What about actually handling the deal documents, the closing, the signatures, all of that? I know virtual deal rooms have been around for since before COVID was, but has there been a greater reliance and use of those kinds of technologies for managing the workflow and the documents around these deals?
Yeah, I think so. I mean, I think that, I think the process for managing a transaction for many years has been done with a heavy use of technology. Right. You look at a closing provision in a purchase agreement. I think it's rare to see a closing provision that has an address for where closing is going to take place. Right. I mean, I think much of this has been done for closing, and I think that is very much the expectation. I think you have seen kind of a proliferation of deal management tools as deal volume really increased, and advisors were really having to juggle a much larger volume of transactions at one time. And so even for myself and at my firm, throughout the pandemic, we were relying pretty heavily on deal management software in order to manage each transaction, what stages the transaction, which action item is with which person, and quite frankly, it made us more efficient in terms of how we managed that transaction and met the client's deadlines.
Yeah. What about the use of e-signatures versus wet signatures? Did you see a change there?
I didn't see a change, but I didn't see a change because I think we were really using e-signatures quite a bit even before the pandemic. Right? Yeah. But absolutely, I think it is probably fair to say that there was a greater reliance on things like e-signatures during the pandemic. And I think that was just the nature of what was happening, what was taking place. But again, I don't know that the change in reliance on these signatures was all that great, largely because I think many people were already kind of transitioning to e-signatures anyway before the pandemic.
Right. Jennifer, does that resonate with what you've seen?
Yeah, exactly. And just with the accelerated timelines, it'd be something that would be really difficult to roll back once we kind of get through this. And so like Chauncey was saying, that the role of technology has a big part in supporting M&A deals. So not just in diligence, but in other areas of practice, like Chauncey was mentioning. So e-signatures, tracking, just other transactional logistics. So like closing checklists and getting closing rooms ready. So yeah, I'm sure even 5 years from now, things will look a whole lot different than they do today too.
Alex, there was a question that came in, and I don't know if your data, how up to date your data is, but there's a question from somebody who said they had heard that deal activity has dramatically slowed down in just the last 4 to 6 weeks. Have you seen anything on that?
I don't know what the last 4 to 6 weeks sound like. Our data could be slightly different from, if those numbers didn't come from PitchBook, they could have come from a provider that includes announced deals, which we don't do. We only capture closed deals. I don't know one way or the other about the last 4 to 6 weeks, so I'm sorry.
No worries. It's fine.
Yeah, I'll add from my perspective.
Yeah.
I've not observed any of deals that are kind of being thrown out there, things that are getting done. I will say that I think that there were a number of deals that had been signed where closing was kind of put off a little bit for various reasons. Some of which may have been pandemic related, some of which may have been related to a change in presidential administration and so on, with a change in agency heads. So I think there may be something there in terms of deals that were signed, but deals that have not yet been closed. And whether some of those deals that are signed but not yet closed actually close remains to be seen. But on the whole, I personally have not observed any slowing down in the last 4 to 6 weeks.
And I would only add to that if there is a slowdown going on right now in the past 4 to 6 weeks, I think it's understandable from a human perspective. I mean, there have been a number of articles and anecdotes that have been coming out that deal teams, especially going down to the associate and analyst level at private equity firms, people are absolutely exhausted. We highlighted the 3-quarter window between Q4 2020 and Q2 2021. In and of itself, that window is higher than any year that we've ever recorded. And it's not only from an M&A perspective, but that also bears true on the private equity side. So there's only so much that you can do as a PE firm, perhaps as a serial acquirer. People are busy, they're exhausted. We're getting into the holiday season we're closing in on the 2-year anniversary of a global pandemic on top of everything else. So I wouldn't be surprised to see some kind of slowdown. At the same time, I wouldn't be surprised that it hasn't slowed down just because of the nature of the business. But just from a human perspective, I think people are pretty exhausted on the deal-making side of things right now.
We've got about 10 minutes left in the program, so if you have a question, now is your time to drop it in there and give it to our panelists. Alex, I wonder, it's something you've alluded to a couple of times, but I wonder if you could talk a little bit more about how geography played into this, particularly cross-border geography and transactions outside the United States or cross-border.
Mm-hmm. Yeah, it's interesting. We did look at cross-border transactions in the report, and whatever trends were impacted by COVID in the overall market were exacerbated on the cross-border side of things. So on the one hand, there were a number of scenarios where acquirers were looking to get a toehold in other parts of the world. We actually highlighted, bear with me just a second, I'll track it down. We highlighted a deal between Just Eat Takeaway, which is actually based in Europe, where they acquired Grubhub in June of this year for $7.3 billion. That was an opportunity for Just Eat Takeaway to come in and get a presence in the U.S. market with a major player in Grubhub. But there were a number of other scenarios where if you did have plans on acquiring internationally and trying to grow your presence, now wasn't necessarily the time. I mean, you're talking about international travel coinciding with social distancing regulations. And there was a hesitation on the part of a lot of firms to, if they were going to acquire companies, they were going to do something locally and they were going to do something that was a little bit easier than a cross-border transaction. On the other side of things, even if they did want to, especially over the last 2 years, there are security regulations in place, chiefly in the U.S., CFIUS, the Committee on Foreign Investment in the United States, I believe. And a lot of those deals will undergo scrutiny from a security perspective. So there are just so many headwinds facing cross-border transactions that it's not surprising to see that those COVID-related impacts were even harder on cross-border M&A. I think the question is when that really starts to rebound, and I think that will I think it'll probably rebound slower than the overall M&A market.
Chauncey, any thoughts on that, on the cross-border market?
Yeah, sure. I mean, I think what Alex just kind of touched on is exactly what I've observed, right? I think first we saw many countries institute controls on foreign direct investments from Ireland, Spain. I mean, we saw it all across the globe. And a lot of it was just in the form of protectionism, right? I mean, as some valuations were really declining, a lot of companies became targets for just easy acquisition. And so you saw a lot of countries looking to kind of protect against that. And so a lot of regulations were implemented. Some of them were implemented pretty quickly. Others were implemented on kind of a temporary basis and then became more permanent. And so that was certainly a pretty big headwind with respect to a cross-border deal. Another headwind was currency risk, right? Currency risk is always present in a cross-border transaction, but in the middle of a pandemic, a global pandemic, currency risk was a much, much bigger issue. And how do you manage that currency risk at a time when you don't, I mean, the currency risk is present both in the US, it's present in Europe. I mean, it was present across the globe, right? And so I think that was also another pretty big headwind, in addition to the travel issues and other access issues that were created during the pandemic.
Yeah. Jennifer, any comment on that?
Yeah, I'm just echoing the sentiments of Chauncey and Alex. And like a lot of the issues with cross-border have to do too with right, like data transfer and data privacy issues and the regulations surrounding that, right? Like we saw the Privacy Shield governing the transfer of data between the EU and the US go away last year. Still kind of waiting for a replacement. A lot of companies are not sure what to do with that. So, you know, it kind of complicates the transactional space more.
Mm-hmm. So the title of this webinar was avoiding buyer's remorse. I'm wondering what the takeaways are from what we've been talking about here, what the lessons are, especially given that a lot of people in the audience are professionals involved in M&A deals themselves. Chauncey, what are your thoughts on that? What should we be learning from these trends, and what should we be doing going forward to respond to them?
Yeah, you know, I think Jennifer will appreciate this first one, and that is integrate technology better, right? And don't wait until the next pandemic comes along. Work on integrating that technology into your process now, from deal tracking, deal management, to due diligence. Integrate that into your process now, so it's already there if we see this again, or let's say there's a recurrence of COVID. You know, I think another thing that's important to keep in mind is that, look, in the due diligence process, much like buyers were affected by COVID, sellers were affected by COVID, right? And so when a buyer is conducting due diligence on a seller, it's thinking about how was the seller impacted by COVID, right? So thinking through in these material contracts, is the seller currently in breach of a material contract because of how it's been affected by COVID? Right. And so I think the way that we conduct due diligence and the way that we analyze these agreements changed a little bit. Right. I mean, we weren't just looking for things like assignability and consent and notice requirements. We were looking for things about what are your obligations under this contract, and have you breached any of these obligations because of the impact of COVID on your business. Right. So I think we had to take a slightly different look at some of the due diligence materials in order to better manage the risk, uncover the risk, manage the risk, and then make sure that the risk was appropriately addressed in the purchase agreement, right? And again, I think that takes us back to technology, right? Relying on AI in the due diligence process can help you uncover those types of issues quickly, and then allow you to pretty quickly assess whether it is a material issue to this target or not. So I really do think that's the bottom line. Is I think look, speed is very important, especially in this very competitive landscape right now, right? Where you've got a lot of pent up demand, you've got a lot of dry powder, and everyone is jockeying for that market share. And I think that you really have to balance the desire for speed with efficiency. Because I think it is between those two things that you uncover the risk and you properly manage the risk. I think that is how you avoid power shortage.
Yeah. Is it your role as an attorney to kind of push back against the velocity of some of these deals at any point?
Yeah, it absolutely is, right? I mean, I think I lightly touched on that a little bit earlier. There is certainly a client management component to this, right? Because and it comes up, and look, this was present before COVID, right? Where you have a client who wants to get a deal done really quick, and there's a legal risk out there, right? And it's my job to present the legal risk to the client, and present solutions for how that legal risk can be managed, right? But I have to be efficient in how I do that, because one, I have to uncover the legal risk early. I can't wait till the deal is at the finish line and then present a legal risk to a client. So I've got to be efficient in uncovering that legal risk, presenting that legal risk to a client, and having that trust between myself and a client that the client will understand that, look, if he's telling me that this is a material risk to me as a buyer, I probably need to stop and listen and work with legal counsel to address it.
Jennifer, what about you? What are the takeaways? What are the lessons? What are the actions that legal professionals should be considering going forward from here?
Yeah, I mean, I think we've seen in the last 20 months that huge increase in the reliance on technology in M&A deals. So I think that's going to continue to become even more ubiquitous in a similar manner that it has for, say, like e-discovery or litigation matters. And so for those of us like working in the legal tech space, we are working on improving the text accuracy all the time and expanding what the AI can actually find, can find more provisions than ever, and is now even starting to answer questions based on what it finds. So there's a real impetus for us to like work on continuing to improve that, and to support lawyers in using the technology to make their deals more successful.
Thanks.
The only thing
Alex,
I would
do you have
add,
thoughts on the? Yeah, go ahead. Sorry.
Yeah, the only thing I would add to that, and I think over the past 2 years, I think a lot of people sort of took for granted the value of dinner, having dinner with folks and building that trust from a personal standpoint. In lieu of that, there's had to be a rush of technology solutions to sort of fill that gap, to make sure that trust is still being built, that everything is still getting done. And it's not going to replace that interpersonal part of deal making. Having a 2 or 3 hour conversation over food or over drinks, talking about where you really see the company going over the next 3 to 5 years. And so it's going to be interesting, again, over the next 3 to 5 years, how those two things interact once social distancing requirements are scaled back and people can start really interacting on a more personal basis again, because it's going to be a slightly different mix. There's going to be more in person, a little bit more back to normal, but then on the other hand, there's also going to be a lot more technology solutions at the ready. So it'll be interesting to see what kind of changes happen going forward to the deal-making process itself.
All right, well, thanks to all of you. I'm trying to determine whether the link was ever provided. Was the link provided for the download of that M&A report? Yes. Okay. The link was provided. So you in the audience should have received that link. If you'd like to download the full report that we've been talking about here, it's a good read. And thanks to Alex for putting that together. Thanks to all the panelists for participating today. And thanks to Latera and Above the Law for producing and presenting today's webinar, and thanks to everybody in the audience for participating and listening. Stay well. That does it for today's webinar.